The Lords Committee versus the FCA, a clash over transparency and corporate accountability. The House of Lords Financial Services Regulation Committee, established in January 2022, has ignited a fierce debate surrounding the Financial Conduct Authority, FCA's proposed name and shame policy for companies under investigation. This clash, fueled by concerns about potential conflicts of interest and the delicate balance between transparency and corporate due process, raises fundamental questions about the future of financial regulation in the UK. The committee, comprising 13 members, 10 of whom have declared current or recent ties to the financial sector, has consistently challenged the FCA's approach. This inherent proximity to the industry under scrutiny has sparked accusations of bias, raising concerns about the committee's objectivity in evaluating the regulator's actions. Critics argue this close relationship compromises the committee's ability to provide impartial oversight, leading to a potential conflict of interest that undermines public trust. The very structure of the committee, with its significant representation from the financial industry itself, invites skepticism regarding its motives and conclusions. The committee's skepticism towards the FCA's regulatory powers forms the core of its two inquiries. The central focus has been the extent and implementation of the FCA's authority, particularly its proposed policy of publicly naming companies under investigation. This seemingly straightforward measure, aimed at enhancing transparency and deterring misconduct, has met significant resistance. Lord Forsyth, a prominent figure within the committee, directly intervened, writing to the FCA in April 2022 to express the committee's strong disapproval of the name and shame proposal. He explicitly requested a halt to the implementation of this policy, pending a comprehensive inquiry by the committee. This preemptive intervention, unprecedented in its direct challenge to a regulatory body, highlights the intensity of the conflict. The committee's opposition isn't solely an internal matter. It mirrors the sentiments of UK finance, the powerful industry body representing the banking and finance sector. UK finance has consistently voiced its opposition to the FCA's proposals, echoing the committee's concerns. This unified front from both the committee and industry representatives underscores the significant resistance facing the FCA's efforts to increase transparency. The FCA's initial proposal, met with a barrage of criticism from businesses and the committee, prompted a significant shift in strategy. After months of sustained pressure, including intervention from the city minister, the FCA responded by initiating a second consultation process in November 2022, offering a modified version of its name and shame policy. This concession suggests that the FCA recognized the considerable weight of opposition and potentially the validity of some of the concerns raised regarding the potential for reputational damage and undue prejudice against firms before a final determination of guilt. However, the concessions are not widely seen as sufficient. The core argument of the committee and its industry allies centers on the potential for irreparable harm to companies under investigation, even before any wrongdoing is proven. They argue that premature disclosure of investigations can severely damage reputation, impacting share prices, investor confidence, and ultimately, the viability of the businesses involved. This argument hinges on the principle of presumed innocence, a cornerstone of due process. They contend that the FCA's approach violates this fundamental principle by potentially inflicting significant damage to businesses before any adjudication of guilt. The argument also raises questions about proportionality. Is the potential benefit of increased transparency worth the potential harm to innocent companies? The FCA, on the other hand, champions the policy as a crucial tool for enhancing market integrity and protecting consumers. They argue that public awareness of investigations acts as a significant deterrent to future misconduct. Transparency, they posit, fosters a healthier and more accountable financial landscape. The FCA's perspective prioritizes the public interest in safeguarding against financial fraud and ensuring the integrity of the market over the potential for reputational damage to individual firms. This ongoing battle between the House of Lords Committee and the FCA exemplifies the complexities inherent in financial regulation. It highlights the delicate balance between promoting transparency and protecting the rights of individual businesses. The inherent tension between the watchdog and the watched becomes acutely apparent in this case, leaving the ultimate fate of the name and shame policy and the future of financial regulation in the UK hanging in the balance. The resolution of this conflict will require a careful consideration of competing interests and a pragmatic approach that balances the need for transparency with the principles of fair process and corporate due diligence. The ongoing debate emphasizes the urgent need for a clear and consistent framework for financial regulation that safeguards both the integrity of the market and the rights of those operating within it. The ultimate outcome will have far-reaching implications for the future of financial regulation in the UK and beyond.